Hey everyone, Brian Bogner and Greg Towner here. It is time for the February 2018 5-minute update. We came to you a couple weeks ago with a live webinar when we were experiencing some market volatility. I just want to follow up on a few things from there. So Greg, when we had that call, we talked about whether the volatility we experienced was just simply a correction or was it a crash? And of course, we said it was a correction. Do you still feel that way?
Yeah, we do actually, Brian. If we look at this first chart here, this is actually the S&P 500 looking back over the past 2 years. And we can see that we're still well within the nice longer-term moving averages, the longer-term uptrends. If we go back to mid-January, we'd drawn that black steep trend line there. It actually kept going straight vertical for a couple weeks after that video that we did. But inevitably can't maintain that pace. So it corrected down pretty harshly, right exactly to the 200-day moving average. Now we've quickly rebounded right around to the green line there, the 50-day, and we've been bouncing back and forth around that for quite a while now, at least a week. We showed a chart during that live webinar you referenced that, a lot of times you have to retest those lows, and so that's kind of still maybe a base case that will happen, a lot of churning back and forth. One thing that we also keep in mind is a lot of time corrections happen not just in price, but over time. So sometimes maybe it's just some time has to go by. Maybe some of the internals of the market have to rotate. Maybe one sector does better, then another takes over. So maybe we just need to see some time. But yeah, we still believe it's a correction at this point and nothing worse.
Okay, so kind of like a little tug of war here going on around these levels, would you say?
Exactly, I would say that.
Yeah, and I mean, we haven't experienced volatility in so long. We've experienced it now, so this year could be a bumpy year.
It could be, yeah, absolutely. Well, compared to last year, for sure.
Yeah. Okay. We've talked about stocks. Let's talk a little bit about interest rates. They've been moving higher. What are your thoughts around that?
Yeah, we've talked a lot about interest rates, and certainly the market has talked a lot about it as well. This is a 2-year chart of the U.S. 10-year yield. So we've seen here in the last few months, rates went up quite a bit. They're perhaps extended here in the short term, almost got to 3% on this 10-year bond. Really kind of extended in the short term, so maybe needs to correct a little bit. If we step back and take a longer term view here, we can see on a same position as far as the U.S. 10-year bond, but now this is a 15-year view. We've clearly broken the long-term downtrend. We're clearly kind of starting to base out. The question remains, have we started a new uptrend? It's probably a little bit early to really define that as having occurred, but you can certainly make that argument. But the bottom line is rates have gone up quite a bit here in the short term, maybe a little ahead of themselves. If we look back at where yields were just not that many years ago, they potentially could go quite a bit higher still.
All right. Sticking with credit, what are your thoughts around just the credit markets in general?
Yeah, I mean, of course, we've looked at the levels of bonds and that, but we know that the market and investors really think the internals of the credit environment are critically important. I know it's something you follow a lot. What are you seeing there?
Yeah, basically here, we're just measuring spreads, right? Which just tell us, when you're looking at, in this case, this black line is a 10-year Treasury, and this orange line is our corporate bonds. So corporate bonds are a bit riskier than government bonds, and we just simply measure the difference between the two. And when this line, that's what this bottom chart is, when the line's rising, it's just telling us that, hey, investors are getting out of riskier bonds like corporate bonds and dumping into safer investments like government bonds. Well, even though we've experienced volatility, you would expect this line to be rising, and we've not seen that. So, that tells us that even though interest rates are moving higher, there's not been a flight to quality or a flight to safety or anything like that you typically see. So this is actually still pretty bullish for stocks.
Okay, great.
Yeah, so we've talked about stocks, we've talked about interest rates. So what do we do with all this?
Yeah, so, tying it all in with stocks and rates, we're looking at a chart here. The bottom, the x-axis on the bottom shows us the 10-year yield, which we were talking about. That blue dot shows us that we're at a little under 3% now. What this chart tells us is kind of the probability as we move up that line of how likely it is that the higher rates become a problem for stocks. So you can see right now we're kind of down in that lower area, maybe only a 20% or so probability that higher rates at this level become an issue. Really, it looks like you have to get up closer to 4%, where you even get a 50-50 chance that they're a real problem for stocks. So tying that in with our trend work and our fundamental work, we still think that you should be constructive on equities here. We think it's probably even more important than normal to focus on quality. You know, we always have quality as part of our QRLT process, Brian. But really, when you have rising rates, you got to be careful even more so, because companies that have poor cash flow, higher debt, they can find themselves in more trouble with rising rates. So in this kind of environment, really important for us to continue to focus on quality, and that's what we're doing. And that's why we think the market is still well positioned for that.
Sounds great, Greg. So just in review, you said stocks corrected in a long-term trend. So, you know, it's just a correction. Trend is still moving higher, but, you know, interest rates are rising, but they're not rising necessarily to a negative inflection point. Credit environment is still healthy, so that's positive. And really what we want to do is continue to focus on high quality and growing cash dividends. So that's great. Greg, why don't you close us out?
Yeah, that's great, Brian. You know, we still feel that we should be constructive on equities, but definitely going to be a bumpier ride this year, so that we want to maintain our risk discipline, build a diversified portfolio, and keep looking out longer term.
All right. Thanks so much, and you have a great day.